Right. Here we are again. So tonight we'll be focusing our attention on options. We've covered futures, forwards, and swaps. Now we're going to look at options. And of course, unlike the others, we're going to spend even more time looking at different strategies because what's interesting about options is that because they're so complicated, there's so many more different ways we can use them to hedge risk than with simple structures like forward and futures contracts and swaps. Although forwards and futures are very powerful hedging instruments, the strategies that we use with them are quite simple, as a matter of fact. You'll see what I mean when we get to that section tonight. Because of the way options are structured, the number of possibilities is much, much greater. And so they can be used to customize hedging positions in ways that would not be possible with forwards and futures or swaps. So that's another of the many reasons why options are so popular among investors. And of course, it also means that there's many different ways we can use them for speculation as well. You could find yourself, for example, gambling that the Swiss franc will stay within a certain range or a certain length of time. Things like that that would be, not really easy or even possible with other types of derivatives. So we'll start by going through the basic features of options. And then we'll dive into the strategies. Okay, so also there's a document that I placed in Brightspace. We'll take a look at it later on. And I found this online. And what it is, it's basically a guidebook to strategies. It was put together by this organization called the Options Industry Council. And, their sole purpose is to educate people on how options work and to encourage investors to potentially at least think about using these for hedging or possibly speculative purposes. But it's a nice little summary about all kinds of different strategies that you could employ using options. So we'll get to that much later on tonight. Also, I did mention, I think once before, that the Philadelphia Stock Exchange, surprisingly enough, is one place where you can actually buy currency options. And one of the good things about the Philadelphia Stock Exchange is that the options themselves are available with much smaller numbers of the underlying currency. So in other words, if you try to buy an option on the Chicago Mercantile Exchange on British pounds, the amount involved is 62,500 pounds, which is quite a large amount. Here, you can get contracts for much smaller amounts, which would be very helpful for smaller businesses. So they have their own summary here of the different features of currency options, and they'll show you here what's available and how many units are available. And so it's a very interesting document. And so I've also posted that for you in Brightspace if you want to look at it. Anything else? No, that's all the goodies that I've given you. So we'll start again with our overview of the properties of options. And then what we're going to do is focus our attention on strategies. Okay, so an option is a derivative security, of course, just like forwards, futures, and swaps. But what really separates it from the others is that you're never obligated to do anything. Okay, a forward contract is a legally binding contract. You are entering into an agreement to buy or sell something in the future. And unless you can get together with your counterparty and agree to unwind the contract, you're expected to actually go ahead and buy or sell the underlying asset. A futures contract actually is the same in principle, but we know that we can offset our position at the exchange by taking the opposite position. For example, if you have a long futures contract to buy British pounds on, let's say, September 1st, and you realize that you don't really need the pounds after all, you can't actually get out of that contract, but what you can do is enter into the opposite position. In other words, get into a futures contract that lets you sell British pounds on September 1st. And so by doing that, what you're essentially doing is offsetting one contract with the other. So we call that offset, and that's pretty straightforward with futures contracts. It's not something that's really feasible with forward contracts. And then swaps are very similar to forward contracts in the sense that they're also over-the-counter products. They cannot be offset. but they can be customized to what we need. So, but having said that, once you enter into a swap, it's understood that you're going to go ahead and carry through with what you've agreed to do. It would be very difficult, if not impossible, to get out of that type of position. So here's options now all of a sudden that enable you to just walk away from your whole position. You have the right to do something, but you're never required to do so. And that's why they're called options, because the performance is optional. Now, options have actually been around for a long time. There are stories about there was apparently a Greek philosopher named Zeno, I think it was. Um, the story goes that, yeah, here he is. Let's see. No, that's not what I wanted. Apparently, this Greek philosopher, I'm pretty sure his name was Zeno, and this is going back to like, God, probably BC times. Let me see if I can find the story real fast. There it is. Oh, I got the wrong name. Thales. So what this guy did was he was a philosopher. Okay, I was right. This is before Christ was born. He was a very well educated man. He was good at a lot of different things, but making money wasn't one of those things he was good at. Okay, he was just like this philosopher. I guess money wasn't too important to him, but apparently, somewhere along the way, someone said to him, "Listen, Thales, if you're so smart, how come you're not rich?" And he said, "I can make money anytime I want. It's just I couldn't be bothered." And so what he decided to do is set out to prove it. And so what he essentially did was he went around the countryside where the primary crop was olives or olive oil, actually. And he bought all these options to buy the presses to press the olive oil from all the farmers so that when the crop was ready, nobody could press any olive oil unless they went to him first. And so he was able to charge whatever he wanted for those olive oil options. And so he did make himself quite a bit of money from this. And then he went back to his philosophy, and that was the end of that. But that's just kind of an interesting story. But anyway, um, now one of the drawbacks to options, though, here's where we have to be careful. Forwards and futures are contracts. Okay, there is no actual price to entering into a contract. It's true that with futures contracts, you have to put money in a margin account, but that's not an actual price. That's still your money. Okay. Same thing is true of the swaps. But an option is something you have to pay for it. You have to buy it, and whether you use it or not, you do not ever see that money again. Okay. It's like an insurance policy. When you buy insurance, if you never use your insurance, you don't get your money back. Imagine calling up the auto insurance company and saying, "Listen, I didn't have an accident this year, so you have to give me all my money back." It doesn't work that way. So with options, you are buying them, and they can be very, very expensive. Okay, so this is really the trade-off with all that power and flexibility. That it comes at a cost. Of course, you have to expect to pay for what you get, especially in the financial markets, which are extremely efficient. Any features you want, you've got to be prepared to pay for them. So now with an option, it can be characterized by several different key features. For example, what exactly is it that you have the right to buy or sell? We call that the underlying asset. And that can be a lot of different things at this point in time. Just a few quick examples. We have interest rates, we have currencies, we have equities, which are stocks, equity indexes, meaning like this S&P 500, precious metals, gold and silver, and then futures contracts. Okay, so you have the right to buy or enter into a futures contract with a futures option. It makes things a little bit more convenient if you don't really mean to buy the underlying asset or sell it. It might be easier if you're just hedging to enter into a futures option. And then we call these, as you can imagine, futures options. So I think we've already seen this example. Let's skip ahead a little bit. You can also buy an option on a swap, which is called a swaption. an option on a forward contract, which is called a forward option. And then finally, you can buy an option on another option, which is called a compound option. Then the strike price is the price that we're allowed to buy or sell the underlying security or asset. The maturity is the time at which the option expires. If it's not used, many options, or most options, I should say, do not have maturities more than 1 year. In fact, usually it's a lot less than that. It could be anywhere from 3 to 6 months typically. So let's say you have a 6-month option on the British pound or to buy the pound. If you wait too long, once that expiration date arrives, you have to make a decision. Do I want to buy the pounds or not? After that, the option expires. And then as far as buying and selling goes, a call is the one that gives you the right to buy the underlying asset, and a put is the one that gives you the right to sell it. All right. Now, I do not know the origins of these names. They are a little strange. Up to this point, we've been using terms like short and long. But for this case, call means you have the right to buy something. Put means you have the right to sell something. And then also, there's two basic styles of options you might run into in the marketplace. The European style options mean you have to wait till the maturity date to decide if I want to exercise it or not. The American style option gives you the right to every day decide if you want to exercise it or not up until the maturity date. So the American style option is clearly more flexible than the European style, but it comes at the cost of a higher price. Okay, it's more expensive, but it gives you more flexibility. So every single day, you have the right to say, you know what, I've decided to exercise this option. The European option, you get one shot, that's it. All right, the premium, this is what you're paying for the option. Why are you paying? Well, the reason for this is because with an option, you have a limit to how much you can lose. There's no limit to how much you can gain. Okay, and that's a pretty big deal. That's one of the things that you're paying for with an option. And this, of course, results from the fact that you have the right to walk away from the whole thing. So I think I may have mentioned this before too. The thing that really held up the use of options in the financial markets throughout the world was it took a long time to develop mathematical models that enabled us to figure out the appropriate price for an option. Okay, so in other words, there was no need for a price for forward contracts, for futures, for swaps. This is different. If you're going to have a security that has a price, it's important to know what the appropriate price is. So in 1973, a very, very important paper was published by researchers named Fisher Black and Myron Scholes, along with Robert Merton, and they came up with the so-called Black-Scholes model. And this is what really made it possible for the traders in the market to understand what the market price of an option should be. Now, unfortunately, this only applied to European options. So it took a while before a model came along for American style options. But when that happened, the market absolutely exploded because suddenly everyone recognized how important options are, how powerful they are. And when they suddenly had a way of pricing them correctly, then that's when this usage of options really started to take off. So let's say 73 is when the Black-Scholes model came along. 76 is when the first model came out for pricing American options. And soon after this, you start to see the introduction of a lot of the options that are available now. For example, currency options only started trading in 1976, and then interest rate options became available in 1979. And so you can see Wall Street is constantly working on new products because they're profitable. Okay, it's just that simple. All right, anyway, so with all that being said, why don't we take a look at what we can do with these things? So assuming that we're not just trying to gamble, we'll discuss that too, but these strategies are designed to help us hedge risk. Okay, so because they're payoff profiles, options can be used to create investment strategies that would not be possible with other assets, such as forwards and futures. By the way, I just want to mention here a couple of details about the way what happens when you buy or sell a put sorry, call or a put. Just as a brief side note here, I just want to mention a couple of details that we need to know. So, um, suppose that an investor buys a call option. Let's say, just to keep it simple, on gold. And let's say the strike price is $2,000 and the maturity date is September 1st. Now, what's going to happen here is that you buy the gold, the option rather, it gives you the right to buy the gold at $2,000 an ounce. Now, here's what we want to know. What happens on September 1st? Let's keep it simple and assume that this is a European style option. So they have to wait till September 1st to decide if they will exercise the option or not. So there's really two cases that we need to consider. Case one, on September 1st, price of gold is greater than $2,000. For example, let's say that it's 2,200. So the investor can now use this option to buy gold for $2,000 and then immediately resell it for $2,200 because that's the market price. Okay, well, that was very nice. And we call this a payoff equals 2,200 minus 2,000, which is $200. Okay, so the payoff, meaning the difference between how much you paid for the gold and how much you're able to sell it for, is $200. Okay, now, oh, by the way, let's make one more assumption here. Let's just say the price of the option is $25. All right, fine. So we say that the payoff is $200. Since the investor paid 25 for this option, his profit is equal to 200 minus 25 equals 175, which means the payoff minus the call premium. Okay. So in other words, yes, the payoff is 200, but I did pay $25. So I actually end up with a profit of 175, which is still not too bad for a $25 investment. Okay. In other words, my $25 is now 200. I've gained $175. Great. Now, on the other hand, let's look at case two. On September 1st, the price of the gold is less than or equal to $2,000. For example, let's say $1,800. So it makes no sense to use the option to buy gold for 2,000 when it is selling for 1,800 in the market. So therefore, the option is allowed to expire. In other words, it is not exercised. Oh yeah, I forgot to use that language here. He used this option to buy gold for 2,000. So we'll say the investor has exercised the option. Okay, good. All right, good. Now, in this case, then, because we just let it expire, we don't use it because there's no point. And you see, this is the advantage with a forward contract, we would have been required to pay the full $2,000 and we would not have been able to save 200 here. So this is one of, you can see why this is more powerful than having a forward contract. But with the forward contract, we didn't have to pay for it. So now what this means then is that because the option was not exercised, the payoff is zero. That's it. There's no payoff at all. And not only that, since the investor paid $25 for this option, his loss is $25 or 100% of his investment. Okay, but that's the worst possible outcome. It's not possible for his losses to go past $25. That's it. We paid 25. If we don't use it, that's it. So you can see their losses are capped at 100%. Whereas over here, look what happened. The rate of return is 200 minus 25 over 25, which is like 700%. Not too shabby, huh? And when else are you going to find that kind of rate of return? All right. Well, anyway, so with all we can now summarize all that with some algebra. This is something you'll see in any options book, and also in probably in that document that I showed you before from the OIC. The payoff can be summarized as so. No, max equals maximum. S is the spot price of the asset. In this case, the gold. X is the strike price. So, in other words, what this is saying is that if the spot price is above the strike, we exercise, and the payoff is the difference between the two. Right? So we can interpret this as follows. If S is greater than X, we exercise the call option and receive a payoff equal to the difference. Okay, which we know is positive. If S is less than or equal to X, we do not exercise the option and receive a payoff equal to zero. So what that means then is the reason why we have that max there is because it's either going to be S minus X or zero, whichever is greater. Okay, you see that? It can't be anything else. It's got to be one or the other. So the payoff is the greater of S minus X, positive, and zero. The payoff cannot be negative. So this is summarized as max S minus X and zero. It's a very compact way of saying it's the greater of the two. In other words, if S is greater than X, we exercise, we collect S minus X, otherwise we get zero. Wonderful. Now, having said that, the profit, which is really the bottom line, to the call is. So we take that payoff and we subtract C. C is the call. Okay. So it's the dollar profit, not the rate of return, but the dollar profit is the payoff minus the call price. Okay. And we saw that already with our gold example. In the first case, the payoff was 200. And then we subtracted the 25 for the call premium, and we ended up with a profit of 175. In the second case, the option was not exercised, so we have a payoff of zero. We still paid $25, and we ended up with minus 25. All right, now that only applies to calls. What about puts? The put, remember, is the one that lets you sell. So let's just keep the same numbers. And this time we're going to assume that we bought a put. Okay. So when you buy a call, by the way, you basically are either you're betting that the price of the asset goes up, or else you're protecting yourself from an increase in that price if you're hedging. So let me just add that as well. The buyer of a call is either speculating on the price of the asset going up, or um, hedging the risk that the price of the asset will rise. So in other words, if you're either a hedger who thinks the price will go up and you're protecting yourself from that, or else if you just want to gamble, then you're all set with a call. Okay. Now with a put, let's just again keep some of these same assumptions. Except this time an investor buys a put option on gold. So it turns out that in practice, puts tend to be cheaper than calls. So I'm going to change this price to, let's say, 15. Okay. Um, now we've got two scenarios. So what I'm going to do is I'm going to cheat here a little bit and copy these and just make the necessary changes. Just because it'll be quicker. Okay, so it's the same case. In this case, the investor will not, since this is a put, exercise the put, payoff is zero. And then, of course, you can see why, because remember, you have the right to sell the gold for $2,000, but it's worth $2,200 in the market. So instead of selling it with your option, you'll just go out in the market and sell the gold. Okay. So his profit is actually a loss, 25, which is 100%. On the other hand, so when it's 1,800, the investor will exercise the put um, and sell the gold. Well, actually, here's what he's probably going to do. He'll exercise the put. He can buy the gold in the market for 1,800 and use the put to sell it for $2,000. This provides a payoff of $200. Okay, so this time he's saying, listen, I have this security in my hands which lets me sell gold for $2,000, but it's only worth 1,800. So I'll buy the gold in the market at 1,800. I'll sell it through my option for 2,000, and I'll put $200 in my pocket. That's my payoff. The profit is then 200. Now remember, we're only paid 15 for the put. And that's $185. So the rate of return is 200 minus 15 over 15. Let me just see what that is. It's a lot. 185 over 15 is 12. Okay, so there you go. So you can see the upper potential is quite high. And now the payoff to a put is going to be just this. We reverse the two. Okay. And then here, let me just make sure I get all changes. We exercise the put and receive the payoff is X minus X. Great. If not, we do not exercise the put and we get a zero. Okay, so that means the greater of these two and this over the put, this is our payoff. And then the payoff to the profit to the put is the payoff minus the put premium, which we'll call. Okay, put premium, right? So the buyer of a put is doing one of two things. He's either speculating on the asset price falling or hedging the risk that the price of the asset will fall. All right. So I think with all that being said, we're ready to take a look at these strategies. Now, the strategies are really they can be used for either hedging or speculation, but the ones you're about to see are really intended for speculative purposes, where traders think that they know where the market is heading, and they want to make sure that they profit if they're right. That's really the point of setting up these positions to say, listen, I'm pretty sure the following thing will happen in the market. Therefore, I want to be in a position to benefit from it. So the options make it possible to do that without risking more than money than you started out with. Okay. Um, and that's kind of nice because, we saw already that, Nicholas Leeson lost a bundle of money more than he started out with by speculating on futures contracts. And he lost $1 billion because he didn't know what he was doing. So we start with the idea of the spread. Okay, now spread means they're combining two different options or more. And the key here is that either they're all calls or they're all puts. It doesn't matter how many there are, as long as they're all the same type. Okay, so why are we doing this? Well, and you can see there's three cases that we can consider. The so-called bull spread, which from Wall Street terminology, as you know, being bullish means you're optimistic about the markets. So bull spread means you benefit from a rising price. A bear spread is the opposite. And then a butterfly spread, well, we'll see. This is a unique case. We'll see what that is all about in a bit. Okay. Yes, this is something you would not, a perfect example is something that could not be done with other types of derivatives. So bull spread benefits when the price of the asset goes up, but there's a cap, an upper cap to its possible profits. So what you're doing here is you're buying an option with a low strike price and simultaneously selling an option with the same type but a high strike price. Now, by the way, before you get any further here, I just want to mention, I forgot to mention this earlier. The same investor can both buy and sell options. Okay, just like this is equivalent taking a short position, but sorry, selling an option is, I guess, equivalent to taking a short position in a forward futures contract. So in other words, except that here, because there's a price, selling an option means that the investor collects the premium, but the buyer is the one who decides whether or not to exercise the option. Therefore, which means unfortunately the seller can lose more than 100%. Well, actually, what I should say is seller can lose because there's no actual investment here, an unlimited amount. Let's put it that way. Since the buyer can earn unlimited amount. Or I should say the seller can suffer an unlimited loss. Since the buyer can earn an unlimited profit. Okay. So they're exactly in the opposite sides of this contract that they're in. And so, yes, so selling is scary business. But if you're both buying and selling, the risk is offset by the fact that you're also buying another option. So in other words, just selling a single option is a terribly risky position to be in. But for the seller of an option, or the seller of an option, can reduce the risk by also buying other options at the same time. So the same trader can do both. They can buy and they can sell. It's not like there's only one place where you can buy or sell. It's different than with, let's say, the forward market, or actually the stock market, where investors have to buy from brokers. Okay, you don't you actually sell. I guess you could. I mean, if you already own shares, you can sell them back to a broker. But to do what we're seeing here, it means you're taking a short position, and it's a very complicated thing to get involved with. Well, yeah, you can do it. You know, you can short sell a stock, but it's very complicated and expensive. So anyway, so in other words, we're going to assume that we're dealing basically here with traders who are in a position, they're dealing with their bank's money. They may be proprietary traders, which means they're finding strategies to make profits for the bank. They could also be just the ones who are executing trades to hedge risks. And all they're trying to do is find the best transactions price. So there's a lot of different motivations for trading. But the bottom line is traders can go out in the marketplace and either buy or sell options. They can sell options that they don't already own by taking a short position, but that makes them hugely vulnerable because it's the other side, the buyers, who decide whether to exercise an option or not. All right, now that we got that straightened out, so no, if you're setting up a bull spread, you're actually buying and selling. Now it's understood that whatever it is you're buying and selling, they're both the same option, except one has a lower strike price. Okay, in other words, you have the same asset, like gold. You have the same maturity date, like September 1st, but let's say one of them has a strike price of $2,000 and the other is $2,100. So if we buy the one with the lower strike and also sell the one with the higher strike, that means we're setting up what's called a bull spread. Now, by the way, this can be done with either two calls or two puts. Doesn't really matter. It affects the cost. But the strategy is exactly the same in both cases. So here's a quick example of this. Now, this is IBM stock. Let's say that we've got a couple of options on IBM, and we decided to set up our bull spread with calls. So it's a bull call spread. So we're going to need two calls on IBM stock that mature on September 1st, except if you notice, we're buying the one with a strike of 50 and we're selling the one with a strike of 53. Now, because a call with a strike of 50 is more advantageous to the owner than the 53 strike call, if you notice here, the price of the 50 strike call is higher than the 53 strike call because it's more valuable. And of course, in the financial markets, that means you have to pay more for the one that's more valuable. So when you do this, I'm buying one option that costs $3 and selling another one that costs $2. That means it's only going to cost me $1 to set up this position. And now I put together a little table to summarize all the payoffs. Here is the payoff to the one you bought. And here's the payoff to the one you sold. If you notice, there's a negative here. All right, actually, let me just summarize that for you very quickly. Since I didn't explicitly mention this before, you'll recall that the payoff to the buyer of a call is max S minus X and 0, which means that the payoff to the seller of a call it's just the negative of that. Okay, now what about the profits and losses then? So the profit to, as we've already seen, the buyer of a call is it's the payoff minus the call price. And then here the profit to the seller. And now here's where it gets interesting. Max S minus X and 0, but guess what? You collected the premium. So that turns into a positive C. Okay, now what about the puts? Good question. The payoff to the buyer of a put, as you recall, is max. Now here we just reverse the roles of the X's and the S, which implies that the payoff to the seller of a put is just the negative. Fine. And then what about the profits? The profit to the seller, the buyer of a put is max X minus S and 0. Then we have to take into account the put premium price, and therefore the profit to the seller and then we just again apply negative to both terms, X minus S 0 plus P. All right, great. Well, all right. So I just wanted to get that in there before we get deeply involved with these strategies, because you'll see all four of these will potentially show up in all of our strategies. So with the bull call spread that we set up, this is the payoff to our long position when we bought this call at a strike of 50. And then here's the payoff to the one we sold with a strike of 53. This is our total payoff. So if I put this into a special type of graph, you notice I've got the stock price on the horizontal axis, the payoff is on the vertical axis. Now here's a couple of points to notice. This is the strike of the lower strike call. And this is the strike for the higher strike call, 53. It's not a coincidence. So as long as the stock price stays within that range, if you notice, as as the stock price rises by $1, payoff rises by $1, but only up to, and then reaches a maximum payoff of $3. The reason for that is because when we get outside of this range, the payoffs to the two options are exactly offsetting each other. It's only in the middle region that we're making money when the stock price goes up. Now, because of the fact that we're making money when the stock price goes up, that's why it's called a bull spread, because we're optimistic about the price of this asset. Now, you might notice though that unlike a call option, this one has a limited payoff and a limited profit. That's because the position is so cheap. Okay, in other words, we are saving money by setting this thing up instead of simply buying the 50 strike call in the first place. So because it's cheaper, it's not as advantageous as simply owning a call if the stock price continues to rise. So you can think of us as being cautiously optimistic. Now, what about the profits and losses? Once we take into account the cost of this position, which is $1, we have to subtract $1 from every payoff. And so we end up with this position. Okay. So this one is the payoff, which does not take into account the cost of the options. And this one is the profits and losses, which does. So you can see you can lose money. This is the maximum loss of $1. There's also a cap on our profits of $2. So we're bounded in between the two. So in other words, it's a fairly conservative strategy because we're saving money, but yet we're also giving up a lot of upside potential. So, it's something that you might do if you think that the price will go up a little bit, but not that much. Now, by the way, I did mention this other document that has some of these interesting strategies. That one is in here somewhere. Let me just see if I can find it. What's interesting, no, that's just the call option by itself. Here it is. That's the one we just did. The reason why I wanted you to see this is because if you notice, they're telling us exactly how to set it up, but they're also pointing out, for example, that it's a bullish position, meaning we're optimistic about the asset price. The risk is limited and the reward is limited on both the lower and the upper side. But it still doesn't actually say that, but it's a fairly conservative position. And so you can see from this graph, this is the limit. You can't go above this part down here or lose more than this. In between, though, you can make money. Now, what can often happen with these strategies is that there could be a reversal of this. For example, what if I have the opposite outlook? I think the price is probably going to go down a little bit, but not too much. So what I can do is reverse these positions. And when we do this, we change the name to a bear spread because now we're basically betting on the price going down. Okay, so with a bull spread, you're betting on the price going up, although not very much. Here you're betting on the price going down a little bit, not too much. Okay. So we call it a bear spread because that means we're bearish or pessimistic. Okay. If you've never heard that terminology before, I'll just remind you that in the markets, an investor who is bullish is optimistic about the future direction of the market. Oops, I left out a keyword here. An investor who is bearish is pessimistic about the future direction of the market. So somewhere along the way in the 19th century, it became common practice to think of the terms bearish and bullish to describe Wall Street. I don't remember exactly how this came about. I remember seeing some of this discussion. There used to be a wonderful museum in the Wall Street district called the Museum of American Finance. And it had a lot of excellent history about financial and economic history from especially the early days of the United States in the Wall Street district in New Amsterdam when the Dutch arrived and first started trading there. But unfortunately, the building was destroyed by flooding and they still haven't found a new home yet. So, but on the other hand, not too far from there, you may know, if you know the city very well, is this amazing statue, which has its own interesting history. The Charging Bull. It's at the intersection of Broadway and Broad Street. And if you go down there anytime, you're going to see mobs of people walking, standing around trying to get pictures with it, or even sitting on it, which they're not supposed to do. And that was donated to the city by a private investor, sorry, private individual who was a sculptor. And he this actually happened in the late 80s. You may recall that in 1987, there was a major stock market crash, October 1987. At the time, the Dow Jones was only around 2,000, which was a record at the time. And one day, out of nowhere, it fell over 500 points in a single day, which is like it would be the equivalent of about 10,000 points now. And so the whole market was in a sour mood. People were pessimistic. And eventually it did bounce back. It took about 2 years to recover all of its losses. And it wasn't ever really completely clear why this happened. But the sculptor thought, the city needs a lift of spirits. So he builds this thing in his shop. And just before Christmas, puts this thing on his flatbed truck and drives up to Wall Street, and he drops it off in front of the Christmas tree, which is in front of the New York Stock Exchange. And so the next day, people came to work and they see this beautiful statue of a bull in front of the tree. It's supposed to lift their spirits. So what happened was the cops had it towed away. So eventually he had to go to the city hall and tell them what happened. And they figured out a compromise. They moved it to this spot where it's in less it's not ideal where it is because there's so many cars going by, but at least there's some space for it. It doesn't really interfere with pedestrian traffic or for cars, that is, because it's kind of like a big triangle where the two streets come together. But it's a very interesting story. Now, there is no bear statue, by the way. It's just the bull. I guess they figured that would be too much to have a bear out there. So there he is. If you're ever in the city, you got to go down and see him. Although just be aware, it'll be hard to get close to him because of all the tourists. Okay, well, anyway, the bear spread then is just the reverse of the bull spread. So whatever you do for the bull spread, you do the opposite for the bear spread. In other words, you're buying the option with a higher strike, and you're selling the one with the low strike. So, okay. You can think of this as the reverse of the bull spread, which means the payoffs will be the reverse too. Okay, in other words, let me jump ahead to the graph so you can see what I'm talking about. So yeah, look at that. All of a sudden, you're making money when the price goes down. So your maximum loss is here, $2. When the price rises above the higher strike option, but there's a maximum profit down here of $1. So you're making money here as the stock drops, it increases your profits, but there's unfortunately a cap at $1. That's as good as it gets. On the other hand, your losses are capped at $2. Now, what's interesting about this position is that since this position requires purchase of a relatively cheap option, sale of a relatively expensive option, the investor is not only not paying for this, is actually being paid to set it up. Okay, so in other words, if nothing happens, if the stock never moves, you'll actually put money in your pocket. you're actually getting money as a result of setting this up, but then you're hoping that the price doesn't go up further, which would take away your profits. So that's kind of unusual. But see, again, this is the kind of thing you would never get with forwards, futures, and swaps. They're too simple. Okay. They're not, because with those, remember, you're required to follow through there with whatever it is you agreed to. It's the fact that you don't have to do anything that makes these positions so sophisticated. Okay. So you can see why all of a sudden, almost overnight, options trading in the United States went to the roof once it became clear how they were supposed to be priced using models like Black-Scholes. The volume of option trading just exploded, let's say. Okay. Now, this is a very interesting one, the butterfly spread. This is something you might not even think about because the one thing that the two that we just looked at have in common, bull spread can be thought of as a speculative position in a rising asset price. Or you can think of it as a bet that this asset price will rise. The bear spread is the opposite, can be thought of as a bet that the asset price will fall, of course. Now, it's not that you can't use these for hedging purposes, but it's very, there are much simpler ways of doing it. You probably would not use these positions to hedge your position. These are really speculative positions. Now, both of these are therefore said to be directional bets, since they are based on future movement of the assets. So you're probably wondering, well, what else could there be? Oh, well, here's an interesting one. The butterfly spread. So let's take a look at this. Now, this one is more complicated because it requires three different strike prices. So here's what you're doing. You've got a 47 strike call on IBM, a 50 strike call on IBM, and a 53 strike call on IBM. What you're doing here is you're buying the low and the high ones. Okay, here it's written here. You're buying the low strike call, which is 47 strike. You're buying the high strike call of 53, and you're selling not one, but two in the middle. Okay, you're selling two of these. You can sell as many or buy as many as you want, by the way. So this is a very complicated one. There's actually four options involved. One each of the 47 and the 53 are being bought. We're selling two of the 50. Why in the world are we doing this? Well, when you see the graph, you may say, well, oh, I see. No wonder we're doing this. So let me jump ahead a little and show you what it looks like. That's the profit and loss to the butterfly spread. Now that's interesting because you can see that at the low end, there's a maximum loss of $1. At the high end, there's a maximum loss of $1. In the middle, our profit depends on how close we get to $50. Okay, so in other words, remember the 50 is the strike of the two that we sold. Okay, so as if the price stays here, that's the best we can do. So imagine the day that we set up this trade, the stock price actually is $50. So what we're basically saying here is that we think the price of the stock will stay more or less exactly where it is right now. We will make money, the most money, if that's what happens. What we don't want to see is the price change. We don't want it to go down or up. Either way, we'll lose money, or at least we'll have less money than we would if it simply stays right where it is. Okay. So let me just, yeah, we're not betting on the direction of the stock. We're betting on something called volatility. All right. So volatility means refers to the amount of movement of an asset over time. Okay, so in other words, let's say with two different stocks. Here's stock one, it hardly moves at all over time. This one is a very low level of volatility. And then this one goes all over the place, and we call this one is said to have high volatility. So if I was setting up a butterfly spread, I would set it up on stock one because it doesn't change too much. And the chances of it staying in the middle are pretty high, I would say. And so that's basically what I'm gambling on. I'm saying, listen, I'm pretty sure stock one is not going to bounce around. And that being the case, I'll make some money. Right there. I want to stay right at 50. I would never do that with stock two because the chances of it staying right there are pretty low. So what we're doing is not betting on the direction of the stocks, but the volatility. Now, this is the kind of thing that would not be possible with the other types of derivatives, or certainly not the stocks themselves. Okay, so this is, you can see the power of these options. It gives us the ability to place bets that would be otherwise impossible. And so this is one of the reasons, again, why options are so powerful and so popular with investors. Okay, so now, oh, by the way, this butterfly spread could be construed as a bet against volatility. Okay, because you benefit when there's low volatility. Butterfly spread benefits from low volatility. But you notice the beauty of this thing is it doesn't matter if the price goes up or down. As long as it doesn't go too much, we'll make money. So we're just hoping that it stays in a narrow range of pricing. So we say that this spread is a bet against volatility. So if you're a trader, you don't know which direction the stock is going, but you're pretty sure it'll stay roughly where it is. This is what you might want to do. Now, what if you have the opposite outlook? You can create what's called a reverse butterfly spread. By the way, for every position out there, you can create the reverse, but just by doing the opposite. And so here, we're selling, you see how these are the opposite of what we had before. We're selling the lower and the higher strike calls, and we're buying the two in the middle. So on the graph, what's going to happen is it's going to flip upside down. Yeah, there it is. Wow, look at that. So here, the profits will be maximized if the stock price moves very low, below 47, or very high, which is 53 or above. We make money either way. We lose if it stays right where it is. Okay. So this one is a bet on volatility. Now, let me give an example, one that you might try something like this. Suppose that a pharmaceutical company is about to announce whether or not their new drug was approved by the FDA? If if yes, then the stock price will likely rise uh, quite considerably. If no, then the stock price, we can imagine, falls substantially. Now, if you really thought you knew which one it was, if you really believed that it would be approved, you could buy a call option. If you really believed it was going to be not approved, you could buy a put option. But if you don't know either way, but you're really pretty sure that the price will either go way up or way down, then in a case like this, a speculator could profit from this situation by setting up a reverse butterfly spread. If you're right, you'll really clean up. Now, here's what could go wrong. What if the next day the FDA says, okay, we have decided to postpone our announcement until next year or something like that, and then the price just stays exactly where it is? Well, then you're in trouble. Okay, then you're going to lose the maximum amount of money. But if they come out with an announcement tomorrow and say either yes, we were approved or no, we weren't, you don't care as the trader which one it is because you're betting on volatility. Okay. That's the beauty of this setup. You don't need to know which direction it's going. As long as it moves by a considerable amount, you're going to clean up. Wow. See, this is exactly the kind of thing that you could never do with forwards, futures, swaps, or the stock itself. All right. All you can do with those is bet on the direction. This is the only time, is the only security where you can actually bet on the volatility. Huh. All right. Now, oh, and of course, as I said before, if you look at this document I gave you, it's here somewhere. I forgot exactly where. There's all kinds of wacky positions. If you flip through this, you'll see some unbelievable. Here it is, long call butterfly. Okay. In other words, this is the one where we're betting against volatility. It says here the market outlook is neutral around the strike price. The risk and reward are limited. Increase in volatility hurts your position. Of course it does. They don't have a separate graph for the reverse butterfly, but you flip it upside down. That's all. Huh. Now, the other thing too is why did they call it a butterfly? I don't think that looks like a butterfly, but there you go. Not all of the names of these positions make sense. You can I've heard, well, anyway, we'll get into that later on, but now all of these positions I've showed you are called spreads because they involve multiple calls or multiple puts. You don't mix them together. The next group of strategies are called combinations. This is different because now you've got at least one call and at least one put. You can't have all calls or all puts because then it becomes a spread. These are combinations, possibly one of each, let's say, two of each, one call, one put, two calls, two puts, or even uneven amounts like one call and two puts, that type of thing. So there are four basic types, but the straddle is the important one. The others are just basically variations of it. So what is important about a straddle? All right, let's look at this thing. Well, a straddle means you're buying one call and one put that are identical to each other in the sense that they both have the same strike price, the same maturity date, and the same asset. Right? Otherwise, it's something different. Now, what in the world is this going to accomplish for us? So let's say we go back to this example of the IBM. We've got a call with a strike of 50. We have a put with a strike of 50. Just by the way, as an aside, in general, calls are more expensive than puts. So we'll say that this one is 3 and this is 2. Oh, wait till you see this diagram. Let me jump ahead to the profits and losses. And you can see it's a big V. Now, the strike is 50. Both the call and the put have a strike of 50. Each one costs, the total position costs $5. So what that means then is that in order to make money, you've got to make up for that cost. So the price either has to go up by at least $5, or actually I should say more than five, because five just means you're breaking even. On the downside, it has to fall by more than $5 to make money. So think of this as the break even, one of the break even points. Okay, now what I'd like to point out to you is this. Let's go back and revisit the butterfly. The butterfly looks like this. Oops, sorry, I meant the reverse butterfly. You notice with the reverse butterfly, it's not that expensive. $2 versus 5, but there's a limit to how much we can make. With this position, which I forgot to mention, this is called a straddle. It's a lot more money, more than twice as expensive, but there's no upside limit on our profits. So here, if you're really crazy optimistic about this, let's say you're sure that the same setup with the pharmaceutical stock, you're convinced that either the price is going to go through the roof or it's going to collapse altogether, then you might want to set this one up instead of the reverse butterfly, because that one has a limit to how much you can make. Like you're looking at a price increase of at least $10, let's say, or a loss of at least $10, because the news will be either insanely good or insanely bad. This might be the way to go. But it's riskier because you have to cover an expensive $5 instead of two before you start making money. So for all the positions that we're looking at here, there's always many different potential variations where we can change it a little bit to make it either more aggressive or less aggressive, where like if it's more aggressive, that means that it's probably going to be more expensive, but potentially more lucrative, or less aggressive, meaning it'll be cheaper, but the potential profits are lower. That depends on, what your outlook is and how much risk you're willing to take and that type of thing. Now, if you notice though, you might have the opposite outlook. You might think that, oh, the price isn't going to change. It'll stay right where it is. So what would you do differently? Well, we have the the opposite case of this would be the reverse straddle, where you sell both the call and the put. Oh, by the way, in option pricing theory, or in the markets, I should say, is that the word rate equals sell. I noticed that I used the word rate here. So in other words, if you see the word right in these slides, it means the same thing as sell. So I'm selling both of these positions, which means I'm collecting quite a bit of money right up front. And this is what it looks like. So it's upside down. Remember we said that before, when you reverse a position, the graph flips upside down. Now you can see here that if it stays where it is, we're going to make a lot of money. All right. But look what happens if we don't. So compare that with the butterfly spread, which is also bet against volatility. But with the butterfly spread, there's a limit to how much you can lose. Ooh, now here, that's not the case, is it? No, it is not. So you can see the potential for losses is huge. So you don't do this one unless you're really sure. Okay. In other words, you could lose more than you started out with in a position like this. So that's when people get, like this is how the Nick Leesons of the world get hammered because they set up positions like this and then they're wrong. And their positions are so large that they end up losing not just a little money, they're getting absolutely destroyed. So, like I said before, the others are basically variations of this. We had the strangle, where the two strikes were a little bit different. So instead of having a pointy bottom, we have a flat bottom. So in other words, this position is a little bit cheaper than a straddle, but it's a little harder to make money. And of course, you have the possibility of making reverse strangle, which means you're selling these two and flipping it upside down. Oh, I did one of these. Okay. And so this is a bet against volatility, but a slightly modified one compared to the straddle. Now, sometimes you might think that, a stock could be volatile, but let's say you believe that it's more likely to go down than up. What you can do is instead of buying one call and one put, you can buy one call and two puts. Okay, now why would you do that? Because if you look at this graph, it means that you make money by the price changing, but you make more money when it goes down than when it goes up. Okay, now this is a very expensive position, but if you're really that confident, this is something you might want to think about. And of course, you can reverse this by selling all three of these. Okay, this is what it will look like. And then finally, the strap is the other way around. You think the right price is more likely to go up than down. So you buy two calls and one put. Um, it's going to look like this. Yeah. So in other words, going up, you make $2 for every $1 that the stock price goes up. Going down, you lose 1 to 1. And again, you can flip this over by selling all these positions. Okay. And so that becomes a reverse strap. Now, we also have a couple of other interesting ones. These are ones that actually involve the stock or I should say the underlying asset. It doesn't have to be a stock. All right. So, for example, we have the covered call, we have the protected put. With a covered call, the owner of a stock is actually selling a call option. And this is what it ends up looking like. So think of this as long stock, meaning you own it, plus a short call. And so in other words, what's happening here is that you're actually putting money in your pocket up front, and then you're capping your potential gains. So this is somebody who doesn't really think their stock is going to head up much longer or too much more, but wants to collect some money now without actually selling their stock. Okay, so it'll work as long as the price doesn't go up too much, or it doesn't fall, of course. If it goes up, there's a limit to how much you can make now. And then the protected put means you own a stock and you buy a put. And it acts as an insurance policy because what it effectively does is it creates a maximum loss for your stock. But you have to pay for it, of course, but it's like buying an insurance policy on the stock without having to sell it. You want to keep the stock, but you're worried about, let's say, the markets will be tough for the next few months. You could buy a put, and that means you are putting a limit on how much you could lose from your stock. So there's all kinds of things we could do with these option positions to help us manage our risk or just plain gamble. So anyway, here's some tables that represent a summary of what we've been doing. Okay. And again, I mentioned this document that I put into Brightspace. If you want to read through here and see some of these other, there's some really crazy ones like, oh my God, like, well, this is called the Iron Condor. It looks a lot like the reverse straddle. Here's the calendar spread where you're actually buying options that have different maturity dates. Oh God, look at this one. This is when you already own the stock and you sell a call and a put. I don't, well, I mean, you can see there's no maximum loss, but there is a maximum profit. All right, now that I believe is it for chapter 5. And also you have this document that gives you a guide to the Philadelphia Stock Exchange options. So 6, let me just remind myself what 6 is all about. Oh, how government affects exchange rates. Let me get that open for a second. So, oh, I see. Okay, that's right. Here, this is basically a brief history of the different kinds of exchange rate systems that you may run into, or we have seen throughout history. We want to understand what these different systems are, what are their good things and what are their bad things, and maybe identify countries that have actually used these different types of systems. So, because this is a completely new topic, I think this is a perfect time to have our break. So let's say we'll come back at, let's say, all right, how about 9 o'clock? We'll come back at 9. We'll at least start this discussion. Okay. So this is a very different subject. I think you'll find it very interesting. And so we'll come back at 9 and we'll start with chapter 6. Okay. So in the meantime, I'll pause the sharing so the recording isn't full of blank time, and I'll see you at 9. Oh, freak. All right, so here we are. So like I said, this chapter is quite different because we're looking at different exchange rate systems that have existed throughout history, and also some of these are still being used today. But what tends to happen is certain types of exchange rate systems are more appropriate during different times in history, depending on what's happening with the global economy and like where if countries are at war with each other, for example, or that type of thing. So all of these systems have definite advantages and potential disadvantages. And so what we're going to do here is start by looking at some of the different types that have existed, basically throughout history. So we have the possibility of fixed exchange rates, floating exchange rates, the so-called managed float, and pegged exchange rates. So basically, the fixed exchange rate system, the central bank of the country has a policy that they want to keep the exchange rate either at a specific level or else within a tight range of levels or values, I should say. For example, if you look at Bloomberg right now, the exchange rate quotes, you'll see, although they don't mention it here, but if you look at all these different exchange rates, you notice how these change quite a bit. Way down here somewhere, we have USD HKD. This is the exchange rate between the US dollar and the Hong Kong dollar. And again, even though they don't mention it here, this is a fixed exchange rate because the Central Bank of Hong Kong has a policy of keeping this exchange rate as close as possible to about 7.8 Hong Kong dollars per US dollar. We could probably look up the exact range of values. Hold on one second. It's really not realistic to keep it at a single value, but you can, let's say the Hong Kong Monetary Authority, it's called. You can probably find out more details on their website. Every central bank has a website, and often this is the best place to find information about that country's economy, but also about how the central bank operates, and a lot of other statistical data may be available. So if you're looking for information about a country's economy, often that country's central bank, their website is the best place to look. So let's see. See, it looks like these are current values, but no, that's not what I was looking for. Okay, well, we'll go to Wikipedia. All right. So a fixed exchange rate system, which they're calling a linked exchange rate system, is when one country pegs its exchange rate to another country. And at the moment, let's see. This is, by the way, I think I may have mentioned this in the class. They've had this system since 1983. That's a long time for any exchange rate system to survive because circumstances can change over time. And something that made sense 10 years ago, 20 years ago, may not make sense now. So the Central Bank of Hong Kong, which is known as the Hong Kong Monetary Authority, has a policy, as you can see from this graph, of keeping the exchange rate as close as possible to 7.8 Hong Kong dollars per US dollar. Now, they do allow some flexibility there, but not very much. And so what has to happen here, in order for this to work, as we'll see in a while, is that in free markets, of course, the value of the Hong Kong dollar will fluctuate. So what has to happen is when the Hong Kong dollar gets stronger, let me just quickly type this up. So the exchange rate between the Hong Kong dollar and the US dollar is fixed at approximately 7.8 Hong Kong dollars per US dollar. Okay, now this exchange rate is by the maintained by the Central Bank of Hong Kong, which is known as the Hong Kong Monitor. So what happens is if the Hong Kong dollar appreciates in foreign exchange markets, let's say that it starts getting down towards, let's say 7.7 Hong Kong dollars per US dollar. Now, the central bank is obligated to do something about it. The central bank is obligated to intervene in foreign exchange markets to weaken the Hong Kong dollar, so that it returns to its fixed rate. Okay, about 7.8. So how do they do this? Now, this is something that it's a little bit more involved, but there's different ways they can go about this. But in a nutshell, the Central Bank of Hong Kong can accomplish this by using its reserves of Hong Kong dollars to buy US dollars in the market. So what is this going to accomplish? This increases the supply of Hong Kong dollars in the market and decreases supply of US dollars in the market. So as we saw, remember we had those diagrams with the supply and demand curves. This has the effect of weakening the Hong Kong dollar against the US dollar. And they'll keep this going until it gets back to where they want it, which is 7.8. Okay, so in other words, they have to keep their eye on the markets every day. Now, every central bank in the world has its own portfolio of currencies. Of course, they have their own currency, but they also will hold typically some foreign currencies as well, so that they can intervene in foreign exchange markets should the need arise. Now, in the US, the Fed doesn't really intervene in foreign exchange markets very often. So they do have some foreign currencies, but it's a very small amount compared to the size of the economy. Whereas other countries like Hong Kong, now if they're serious about this, they have to have a fairly large portfolio of foreign currencies, US dollars in particular, in order to intervene in foreign exchange markets and make sure that the exchange rate doesn't change. So if they see that the Hong Kong dollar is getting stronger for whatever reason, then they step in, and by increasing the supply of Hong Kong dollars in the market and decreasing the supply of US dollars, that has the desired effect of pushing the Hong Kong dollar back towards the fixed level that they are hoping for. Okay. In other words, they don't completely control this. They have a target. They don't actually choose the exchange rate. The market chooses the exchange rate, but they can influence it by jumping in and intervening in foreign exchange markets. So at the same time, of course, on the other hand, if the Hong Kong dollar starts to weaken, and we'll do the opposite example. For example, rises to 7.9 Hong Kong dollars per US dollar. Well, then they do the opposite. Central bank is obligated to intervene in foreign exchange markets to strengthen the Hong Kong dollar until it returns to its desired fixed rate. So they'll just do the opposite. The Central Bank of Hong Kong will then use its holdings of US dollars to buy Hong Kong dollars. This has the effect of increasing supply of US dollars in the market and increasing and decreasing supply of Hong Kong dollars in the market. As a result, Hong Kong dollar strengthen until it returns to 7.8 Hong Kong dollars per US dollar. So in other words, a fixed exchange rate means the central bank is prepared to intervene as often as necessary to keep its exchange rate at the level that it wants. Now, why are they doing this, by the way? There are some key advantages to a fixed exchange rate. For one thing, it typically keeps inflation low. And so in those countries that have had a history of a lot of inflation, sometimes they'll adopt a fixed exchange rate to help impose some discipline on the economy and keep inflation lower than it otherwise would be. And it also typically keeps interest rates fairly low. Certainly lower than they would have been otherwise. It reduces foreign exchange risk, or it basically eliminates foreign exchange risk to foreigners who want to buy the country's goods or invest in its financial assets. So, in other words, imagine Americans wanting to buy Hong Kong goods with no foreign exchange risk. It makes it much easier to do business in Hong Kong. Okay, like, well, we could even open up a division in Hong Kong and not have to worry about foreign exchange risk. And also, Americans want to invest in foreign Hong Kong's, let's say, stocks and bonds. It reduces or eliminates all that foreign exchange risk. So basically, what it's doing is these factors will make it easier for a country to have strong trade balance, attract capital inflows, and encourage foreign investment. Now, the only problem here, though, there is one drawback to a fixed exchange rate. And this is one reason why not that many countries have one at this point in time, by the way. It used to be a much more common thing. Now, you don't see it very often anymore. And when countries do have fixed exchange rates, it's almost invariably with respect to the dollar, although once in a while you see it tied to the euro, but mostly it's the dollar. And that would be because of these countries do a lot of their trade with the United States. Or, just as a quick side note here, Denmark does have a fixed exchange rate with the euro, but that's because they do most of their trade, obviously, with the European countries. They use the euro. I don't remember when they introduced this. When did Denmark peg its currency to the euro? Now, here's an interesting, we're going to get to this eventually. We're going to talk about the creation of the euro, but you know that the euro hasn't really been around all that long. It was first introduced in 1999. That was the first year that countries started using it. And originally, Denmark was supposed to join this eurozone, as it's called, but I guess it backed out at the last minute. By the way, some of the countries who joined the eurozone and used the euro as their own currency, the government just basically said, "That's it, we're joining." In some of these cases, it was up to the people. There was a referendum, and the people were allowed to vote yes or no. We want to become part of the eurozone. And in fact, in England, the same thing. They had a referendum, and it lost by 2 or 3 points, if I remember correctly. So England never joined. They kept their own currency throughout this whole experience. And that actually made it easier for them to leave the European Union during Brexit. Okay, now Denmark, actually, when this whole thing was being created in 1992, Maastricht, I think, is in the Netherlands. This is where these European countries gathered to hammer out the agreement that eventually led to the creation of the euro, which is called the Maastricht Treaty, as you can see. But at the time, it looked like Denmark had every intention of joining. It is, oh God, that's not helping. Oh, it is in the Netherlands. Okay, that's what I thought. Okay, so anyway, so the Danes were originally thought it was thought they were going to join, but when they agreed to this treaty, they basically held out for a clause that said they don't have to join if they don't want to, which is a good thing because then the government announced in 2000 that they were going to have a referendum and they're going to put it up to the Danish voters. Do you want to join or not? And so they lost. Okay, so that means no euro for for Denmark. But Denmark is a small country. The majority of their trade comes from obviously those other European countries, and also a lot of their GDP comes from trade as well. It's not like the United States. The United States is a very unique case. Only a relatively small percentage of our GDP is actually coming from trade, much smaller than most other countries. So, to a small country like Denmark, trade is like, you know, they're they would, let's just say that it's a much more important part of their economy than for the United States. So, um, that being the case, you would think that it would make sense for them to be part of this eurozone, but because the whole point of the euro is to reduce foreign exchange risk between the member countries, but they voted it down. So later on, um, well, what happens is their currency is not exactly fixed, but it trades within a band, as you can see here, of 2.25% on either side. Okay. So in other words, they allow it to go up by 2.25% or down and no more. After that, they step in and they intervene. So it's not exactly a fixed exchange rate, but it's sometimes called a pegged, or it can have different names, but let's see, what do they call it here? Peg. Well, all right. Like there's different ways we can refer to it. Sometimes it's called there's so many names, but the idea here is that it's fixed, but only up to a point. But you can see why it makes sense for them because again, their trade they're so dependent on trade, which mostly comes with the European countries. So they want their currency to be somewhat fixed to the euro so that there isn't a lot of foreign exchange risk for the other European countries. But anyway, with all that being said, what is one of the really big issues with a fixed exchange rate? It is not possible for the central bank to conduct its own independent monetary policy. Okay. In other words, in the case of Hong Kong, for all practical purposes, has to keep more or less the same interest rates as the United States because they can't do anything about it. They can't adjust it because if they do, it'll affect the value of the Hong Kong dollar. And, then they've given up their obligation to keep it fixed at 7.8. Because you can't have it both ways. You can't have your exchange rate fixed and yet do whatever you want with your own interest rates. So you're sort of tied to the United States in that sense. So if, for example, Hong Kong's economy falls into a recession, the central bank can't lower interest rates to stimulate the economy while maintaining the fixed exchange rate. Okay. Now, of course, they don't want to give up the fixed exchange rate either because it's worked so well for them. So they're going to put up with a little bit of not being able to adjust their own interest rates in exchange for the benefits that it brings them. And so, I mean, the fact that they've had it for 40 something years indicates that they really believe that this is a very good system for them. But again, Hong Kong is one of those countries that's heavily dependent on trade. More so than many other countries, because let's face it, they don't have a whole lot of resources. And in fact, we could look that up too. And of course, and it is a relatively small country. How depend, all right, let's put it this way. What percentage of Hong Kong's GDP comes from trade? Now you can see here, it's actually more than 100%. You might wonder how is that possible? What they do is they import parts. Let's say they're building computers. They import parts from other countries, and then they add value to that by producing the computers in their own country, and then they sell them abroad. And so what they're basically doing is they're taking parts worth a certain amount of money, and with their labor and all the rest, they're converting it into something that's even more value. So that's how a small country like this can actually have a trade being worth more than 100% of their GDP. Okay, it's very strange. It's the same thing with Singapore. Um, but like if you went to the United States, it's going to be like 20% at the most. Oh, all right, 27%. Okay, it used to be smaller than that. Yeah, if you go back here, you can see it's been rising fairly steadily, but it used to be, it was more or less 20% or even less. And that's just because we can produce a lot of things that we need on our own because we have the resources that a Hong Kong doesn't have. Okay, so anyway, um, so yes, this is what fixed exchange rates are all about. Now, in the past, um, things were different. More countries had fixed exchange rates than today. In particular, from 1944 to 1971, the United States and Western Europe um, had a system of fixed exchange rates known as the Bretton Woods system. Now, what this is all about is as World War II is winding down, it became clear that the war is going to be over soon. We have to rebuild Western Europe. How do we do that? Well, one way we can do that is to reestablish trade relations. And so we wanted to make sure that we could trade more easily with Europe. And so one way to do that is to eliminate foreign exchange risk by having a system of fixed exchange rates. What's interesting, though, is that in those days, um, the currencies of Western Europe, and by the way, in these days, there was no euro, so each country had its own currency, were tied to the US dollar. And the US dollar was tied to gold. Now, let me write down the price at which it was tied to gold. You're going to laugh. At a price of $35 per ounce. Okay, so what that meant was, in principle, if, let's say, France earns dollars through trade with the United States, they could, in principle, convert those into gold at a rate of $35 an ounce. Okay, so the purpose of the gold is to, of course, keep the system stable and prevent any increase in inflation, but just also to give the system some credibility. Now, the system was eventually abandoned, but because it had basically outlived its purpose. And then all the member countries then adopted flexible or floating exchange rates, which are determined in the market by the forces of supply and demand. Which is what we have now. In other words, supply and demand is determining exchange rates. But during this period, it was fixed by agreement between these countries. And, it worked pretty well for a while. It did help rebuild the Western European countries, but after a while, it outlived its usefulness, and it was finally abandoned in the early 70s. So that would be an example of fixed exchange rates. But now you don't see it very often. Let's see, maybe we can come up with a list. How many countries have fixed exchange rates? Okay, well, you can see, yeah, it's mostly very, very small country. Well, there's Denmark and the euro. These are pretty well, very small economies. The largest one here is by far is Denmark. Hong Kong right there. You can see they're trading in a range from 775 to 785. And pretty much, if you look at the list of currencies that they're tied to, it's almost invariably the dollar or the euro. Maybe here and there is the British pound. Pretty much that just reflects either who their major trading partners are, or there might be other historical reasons for having that particular country. Or possibly geography is the determinant. Like this country, this is one of the former Soviet republics. That's why they're tied to the ruble. Um, some of these others, I guess they pick the dollar because it's so stable. But obviously countries in the Caribbean, like Barbados, Belize, which is in Central America. Um, that used to be British Honduras, by the way, if you remember back in the day. Bolivia tied the US dollar, Brunei would be Singapore, Bulgaria. So, it's not, I guess I should have said there's a very few countries that have it. What I should have said was the countries who do have a fixed exchange rate, it's mostly are very small. And so their economies depend heavily on trade. And so it makes sense for them to use or have a currency that's tied to the dollar or the euro. And you notice it's called the anchor currency. And this is the exchange rate at which it's fixed. Now, once in a while, sometimes these countries have to abandon this fixed exchange rate. It has happened before if it no longer makes sense. And what they'll do is they'll switch over to a floating exchange rate. Um, you never know how long these ties will last. But there's Denmark. But the rest of the world is using pretty much floating exchange rates. Now, there are certain types of exchange rates that make sense for short periods of time, like after the Soviet Union fell apart, the former communist countries had exchange rates that were tied to the dollar, but within a very wide band. They had to readjust it fairly often. The idea of a fixed exchange rate is that it's meant to be stable. It's meant to be something you can count on or depend on. Otherwise, it kind of loses its credibility, and then the effectiveness disappears. But anyway, so that's what fixed exchange rates are all about. Oh, what was next? Okay, we're freely floating, which is, like I said, simply means that they're determined in foreign exchange markets by supply and demand. Most countries have a freely floating exchange rate. But then some countries will have freely floating exchange rates, but the central bank will intervene sometimes when their currency is, especially when the currency is depreciating very quickly. Um, so actually, I see it's 9:30 already. I'll tell you what, we'll save this discussion, the rest of this for next week, because it's a very complex topic. And so I think maybe it would be best if we save the rest of this for next time. So yeah, there's a lot of good history here, including the origins of the euro, which is still, by the way, I don't know if you're aware of it, but that was the first time in history that we had such a large system of group of countries giving up their own currency to join a single common currency. But we'll discuss that next time. Okay. So all right, so I'll knock it off here. And now I know I looked at the the MindTap problems, and so I know that we are far enough ahead, so you can definitely do the MindTap problems that are due this weekend. So we'll just take it from here next week. Okay, and don't forget about those MindTap assignments. Okay. All right, so see you all next time.
Right, good night.
All right, good night.
Bye. Thank you.
All right, bye.